This podcast is based on the 2025 Guernsey Financial Services Commission annual report. Its content and narration, including voices, were generated using AI and reviewed by the Commission.
If you only glanced at this year's GFSC annual report, you might think it was mostly a list of regulatory activity. Applications, thematic reviews, enforcement cases, financial statements and the like.
And in a sense it is. Annual reports have to do that. They account for money, decisions, staff, policies, risks and performance. They are not meant to be beach reading.
Although there is a beach in the story, because this is Guernsey, and everything eventually comes back to the island itself.
Exactly. What makes this report worth talking about is that it's really about a much bigger question. How does a small international finance centre remain trusted, competitive and serious at the same time?
And how does it do that without turning regulation into a thicket of process that good firms have to hack through before they can get on with useful business?
That is the tension running through the report. Growth and control, innovation and reputation, local prosperity and international credibility.
So today we are taking the GFSC annual report for 2025 and asking what story sits underneath all the tables, initiatives and enforcement updates.
Mercifully, not with a line-by-line tour, but a discussion of the main argument, what the Commission says it did, what it thinks is changing, and why that matters for Guernsey's economy, its institutions, and its place in the wider financial world.
Let's start with the big picture. My reading is that this report is trying to say 2025 was a year of delivery, but delivery in service of a particular philosophy.
That philosophy being proportionate regulation.
Yes, but not proportionate in the weak sense. Not letting everyone do what they like, but more regulating the things that matter. Regulate them seriously, but do not confuse seriousness with adding process for its own sake.
That's important because Guernsey's financial services sector is not a domestic sideshow. It is central to the island's economy and to Guernsey's relationship with the outside world. If the jurisdiction is not trusted, firms lose access, clients lose confidence, and the island's reputation suffers.
And if regulation becomes too slow, too expensive, or too cautious, then firms and capital go elsewhere. That is the growth concern. People sometimes talk as if growth and regulation are opposites. They are not. Bad regulation can damage growth. But credible regulation is one of the reasons good business comes here in the first place.
The report's opening material makes that point fairly clearly. The chairman's statement emphasizes consultation, dialogue, and responsiveness, but also says the Commission is legally mandated to regulate and secure compliance. The balance is explicit. Compliance, yes, but in a way that encourages profitable growth and attracts new entrants.
That's a more useful way of putting the question. It is not regulation or growth. It is whether the regulatory system helps good firms do good business while keeping bad actors out.
And the Director General's statement pushes that harder. It challenges over-regulation quite directly. It argues that the world has changed, that the old policy consensus is under pressure, and that firms and jurisdictions need to adapt.
There is a slightly bracing tone to it.
There is. But the useful part is the distinction it keeps making. Regulation is necessary because financial crime, misconduct, weak governance, and consumer harm are real. But regulation becomes counterproductive if it turns into value-free makework.
That phrase is helpful, because anybody who has run a business, worked in compliance, or sat on a board knows the difference between a rule that makes you safer and a process that simply requires sensible people to prove, again and again, that they are sensible.
And for Guernsey, the stakes are higher because it is a small jurisdiction. It cannot afford to be cavalier, but it also cannot afford to regulate as if it has infinite time, infinite staff, and infinite capital.
So the report isn't saying less regulation. It is saying better regulation, more judgment, and a clearer sense of what the regulation is for.
I think we should stay with that philosophy for a moment, because the Director General's section is doing more than giving a management update.
Correct. It's almost an essay on why regulation exists at all and why it can go wrong.
Exactly. He starts from the idea that we are living through a period in which conventional policy wisdom is being challenged. In the United States, in Europe, in the Middle East, and in the United Kingdom, the assumptions of the last couple of decades are shifting.
And his point is not simply that Guernsey should copy whichever large country has moved most recently.
No, the point is that a small jurisdiction has to notice when the world around it changes. A rulebook that was sensible at the beginning of a decade may not be equally sensible at the end of it. Circumstances change. Technology changes, international expectations change, the competitive position changes.
That's the law-making point, really. Law is not just words on a page. It is a framework for human activity. If the framework becomes detached from reality, it either stops people doing useful things, or it stops commanding respect.
And he makes a distinction between regulation as a dirty word and regulation as a form of law. Once you say it's law, the question becomes more serious. We need law because we need trust beyond family, clan, or personal acquaintance. Complex societies need rules that allow strangers to do business with one another.
That's a good way to explain financial services, actually. Finance is built on promises, custody, disclosure, capital, solvency, and trust. If people can't trust the framework, they don't invest, insure, borrow, lend, or place assets here.
Precisely. And modern financial services are complicated. Digital finance, even more so. So the answer cannot be a nostalgic wish for a world with no rules.
But nor can the answer be that every new risk requires a new layer of process, forever.
That's the tension. He is asking, what is beneficial and necessary to support complex, high-trust commerce and what becomes overly precautionary and destructive of the common good?
And there's no final answer, is there? That's what I found interesting. The report is not pretending there is one perfect regulatory setting. It's saying the right balance has to be revisited.
Yes, that is the adaptation theme. After the Moneyval process concluded, the Commission had more capacity to think and act on reform. The report then lists quite practical changes: the improved private investment fund structure, the family PIF changes, the bank resolution law, equity release, the applications and authorizations portal, and the first planks of the digital finance initiative.
So the philosophical bit isn't just decoration. It leads directly into actual delivery.
Exactly. The argument is, if the world is changing, Guernsey should use the room it has, legally and internationally, to make its regime clearer, more usable, and more attractive for honest entrepreneurs.
Usable, I like that word. It's plain, but it matters. A system can be theoretically elegant and practically maddening. Good law has to be capable of being used by the people who are supposed to comply with it.
And by the regulator that has to administer it.
Yes, if a small jurisdiction builds a regime so complex that only a handful of specialists can navigate it, that's not sophistication, it's fragility.
The report also links this to competition. It mentions the Oliver Wyman work with the states of Guernsey, Guernsey Finance, and industry representatives to test where Guernsey sits against competing jurisdictions. That is an important institutional move, not assuming that Guernsey's strengths are permanent, but testing them.
Which is healthy. You can be proud of Guernsey's reputation, and still ask whether the offer is sharp enough for the next decade.
And the global context matters. The report talks about uncertainty in the US, changes in the EU, reforms in the Middle East, challenges in the UK, wealthy entrepreneurs leaving the UK, and the acceleration of AI.
That makes the regulation question much less abstract. If your main trading partner is under pressure, if clients are moving, if technology is changing how firms work, then keep doing exactly what we did before is not a strategy.
But adaptation has to be disciplined. For a jurisdiction like Guernsey, market access depends on being seen as serious. Reform must not look like lowering standards for short-term gain.
No. The sweet spot is reform that makes the system easier for good business and harder for poor business. That's the bit people sometimes miss. Simpler does not have to mean softer.
Indeed, sometimes clarity makes enforcement easier. If the law is clear, then the expectations are clear, and serious misconduct cannot hide inside procedural fog.
So there's a kind of public philosophy here. Rules are needed because trust is needed. Rules must adapt because life changes. And rules become harmful when they forget the real goods they are meant to protect.
That's well put. And it sets up the rest of the report because many of the 2025 initiatives can be read as attempts to make that philosophy operational. Let's move from philosophy to delivery. The headline numbers are quite useful. The report says there were more than 550 applications in 2025, with more than 220 received through the new Applications and Authorisations portal.
That portal matters more than it sounds. For people outside the sector, an authorisations portal sounds like an internal IT project. But for firms, especially firms trying to set up or expand, the authorisations process is one of the first practical tests of whether a jurisdiction is easy to deal with.
And the report says that all application forms were submitted via the portal by November, allowing the Commission to stop accepting applications by email. That is quite a big operational shift.
It means less paper chasing, fewer email chains, clearer questions, and a better audit trail. If you're serious about making it easier for good firms to do good business, this is the unglamorous plumbing that matters.
The report also says users rated the new process positively across areas such as finding and completing applications, clarity of questions, and communication.
That's good, though I would always want to know how that experience develops over time. A portal can be brilliant in year one and become a maze if it is not kept simple.
Yes, usability isn't just a launch event, it's a continuing discipline.
There's also a broader point. The portal isn't just an applicant interface. The report links it to the Commission's data transformation. If the data is captured properly from the start, supervision can be more intelligent later on.
Which brings us to technology. The Commission has created a Technology Supervision Unit and a Technology Innovation Unit. Those sound similar, but they're doing different things.
One looks outward and one looks inward, right?
Broadly, yes. The Technology Supervision Unit supports frontline supervisory divisions, banking and insurance, investment, fiduciary and pensions, and financial crime. It helps supervisors to understand firms' technology use and contributes to on-site visits and risk assessments.
So not technology as theatre, technology as part of supervision.
Exactly. The Technology Innovation Unit, on the other hand, looks at how the Commission itself can use new tools. The report mentions AI proof of concepts, including an AI-enabled meeting assistant, a secure generative AI chatbot for document analysis, and exploration of a simple agentic AI system.
That's interesting, but it needs care in how it's explained. People can hear AI in regulation and either think marvellous, instant efficiency or alarming machine-made decisions.
The sensible middle ground is that AI should support human judgment, not replace it. A regulator can use technology to find patterns, read documents faster, and reduce administrative drag. But decisions still need accountability, context, and judgment.
It's the same point again, really. Technology should make the work better. It should not become a way of pretending the difficult human decisions have disappeared.
The biggest technology-facing theme is the Digital Finance Initiative. This is a program with three main elements: the Digital Forum, the Digital Finance Regulatory Strategy, and the Innovation Sandbox, plus the Concierge Service.
Let's unpack that. So, the Digital Forum is engagement?
Yes. The report says the Commission held roundtables on tokenization, stablecoin infrastructure, custody of virtual assets, AI and financial services, among other themes. It's a way of hearing from industry and experts before regulation is fixed in place.
That's sensible. Digital finance is a field where the worst mistake would be to regulate based on slogans. You need to understand what firms are actually trying to build.
And the Digital Finance Regulatory Strategy consultation included proposals around stablecoin issuers, tokenized securities, tokenized funds, digital insurance contracts, and amendments to the Financial Crime Handbook to support technology-enabled compliance.
Technology-enabled compliance is an important phrase. The bad version of digital finance is new technology, creating new ways to launder money, mislead clients, or evade rules. The good version is technology improving the quality, speed, and precision of compliance.
And that's where reputation and market access come in. Guernsey can't simply announce that it's open to digital finance and leave it there. If other jurisdictions or standard setters think the island is importing financial crime risk, market access becomes harder.
But if Guernsey is too slow or too nervous, then good innovation goes elsewhere and the island falls behind the curve.
So, the Sandbox plus Concierge is an attempt to create a controlled route in. Existing and prospective licensees can engage with the Commission early on innovative propositions before a full application is ready.
That's good for firms because they get early clarity, it's good for the regulator because it can see what's coming, and it's good for the jurisdiction because innovation isn't pushed into a grey zone.
It also signals that the Commission isn't anti-innovation, but it is not credulous either.
That's the phrase I'd keep coming back to. Not credulous, but not obstructive.
And that is a grown-up position for a jurisdiction like Guernsey, especially now, when AI and digital assets are moving faster than ordinary regulatory cycles.
Which takes us back to adaptation. If the law waits until every technology is settled, it will always be late. But if it rushes in before it understands the technology, it can lock in the wrong assumptions.
So the Forum, Sandbox, and Concierge are a way of learning before hardening.
That's a good way to put it. Learn before hardening, and then when rules are made, make them clear enough to be useful. The policy work in the report is quite practical. The private investment fund regime was updated and streamlined. The prospectus rules were updated. Sustainability reporting moved toward anti-greenwashing guidance, and equity release was brought into regulation from the start of 2026.
The PIF reforms are particularly relevant for growth. The report says 2025 was the best year for private investment funds since the regime launched in 2017.
That matters a lot because the fund sector is very competitive. So if Guernsey can make a regulated private fund product simpler and more usable without compromising standards, that is exactly the sort of proportionate reform that helps growth.
The report also says the Commission launched a limited POI license, making it easier for fiduciary firms to administer family PIFs, recognizing how private wealth and funds activity can connect.
Again, practical. Not a grand slogan, but a change to the plumbing that may make a real difference.
The prospectus rules change is similar. The offer threshold for registration moved from 50 to 200 non-qualified investors.
Which sounds technical, but the policy question is simple. Where is the line between investor protection and unnecessary friction? Moving that threshold suggests the Commission listened to industry and adjusted the rules.
Sustainability is slightly different. The report says the Commission issued a feedback paper on sustainability reporting in the bailiwick and confirmed it would introduce anti-greenwashing guidance and updates to the Finance Sector Code of Corporate Governance in 2026.
That's an area where reputation matters intensely. Green finance can be useful, but greenwashing can damage trust quickly. Claims about sustainability cannot just be treated as marketing colour.
And then equity release. This is more directly consumer-facing. The report says the states asked the Commission to put in place a regulatory regime, which went live on January 1st, 2026.
A great example of regulation enabling rather than obstructing. Equity release had previously been unregulated, which had deterred providers. Regulation may allow a product to exist with more reassurance for older people.
Although the report is cautious about take-up.
Quite rightly, equity release is not magic. It can be helpful, but it needs care. The key point is that regulation can create confidence where the absence of a framework would prevent a market from developing responsibly.
It is another example of law being enabling, not merely restrictive.
Yes. Sometimes the absence of law does not create freedom. It creates uncertainty, and uncertainty can mean nothing happens.
Let's look at the main sectors. We'll start with banking. The report says the number of banks in Guernsey remained at 21. Profitability was relatively good, defaults were low, and capital levels were above regulatory minimum.
That's reassuring.
Total banking liabilities fell from £127 billion to £91 billion between June 2024 and June 2025. But the report says that this largely reflected a decline in interbank deposits, while third-party deposits remained stable.
So not a simple banking has shrunk dramatically story.
No, it needs context. The Commission also carried out 6 on-site visits to banks. Themes included financial crime mitigation and local staffing, especially compliance capacity.
Local staffing comes up a lot in Guernsey. It's not just a business inconvenience. For a regulated sector, finding enough skilled compliance and governance people is part of resilience.
Banking resolution is also important. The Bank Resolution Law is now in place, and the Commission will begin making the Banking Resolution Committee operational in 2026.
That's one of those topics that only becomes visible when something goes wrong.
Which is why it matters before something goes wrong.
Now, investment, fiduciary and pensions. The report says applications were up by around 5% on 2024 on a like-for-like basis, with investment being particularly strong.
The statistical data shows total investment funds falling from 919 to 892, but investment licensees rising from 695 to 710, and PIFs rising from 104 to 132.
That's a more interesting story than up or down. The sector is changing shape. Total fund numbers softened, but private funds and licensing showed resilience.
The supervision section also talks about conflicts of interest, AI use, and fiduciary investment monitoring.
Investment monitoring is a very practical risk. If someone entrusts assets to a fiduciary structure, there must be proper oversight. Poor investment performance can happen for legitimate reasons, but weak monitoring is a governance issue.
Insurance remained brisk, especially captives. The report says the captive sector continued to show strength, though local reinsurance has not yet reflected global market growth.
And the insurance supervision themes are telling. Regulatory reporting, life insurers, also use, and the need for non-executive directors to be more challenging.
That last point really matters. A NED is not there to decorate the governance chart. If local entities are treated merely as extensions of wider groups, Guernsey policyholders and the local regime can be exposed.
Which again connects to reputation. Strong governance is not glamorous, but it is one of the foundations of being taken seriously. Conduct is where the annual report connects most obviously to ordinary residents.
The report mentions retail vehicle finance, online scams, retail banking customer service, and equity release.
Online scams are a good example. People hear about financial regulation and think of banks, funds, and international standards. But for a resident who has been scammed, the question is much more immediate. Did my bank treat me fairly? And what protection do I have?
The report notes that the UK's authorised push payment scam reimbursement regime does not apply in the bailiwick. But the Commission expects local banks to treat customers fairly and continues to monitor practice.
That's a delicate area. You don't want rules that create moral hazards or impossible obligations for banks. But you also can't have vulnerable customers bearing the whole cost of increasingly sophisticated scams.
The Commission also began an external review of retail vehicle finance with results due in 2026.
That'll be worth watching. Consumer credit is an area where poor practice can affect people who are not financial specialists and may not have much bargaining power.
This is where the report needs to stay grounded. Regulation is not just about international perceptions, it also shapes whether residents are treated fairly in everyday financial transactions.
And there is a connection with growth here too. A prosperous finance centre cannot be indifferent to consumer confidence at home. People need to believe that the system is competent, fair, and alert to real harm.
Financial crime is where international reputation and market access become very concrete.
Because if Guernsey is not trusted on anti-money laundering and countering terrorist financing, access to markets and correspondent relationships will become more difficult.
Exactly. The report follows the conclusion of the Moneyval evaluation. It says that the end of the inspection process allowed the Commission to shift focus toward implementing recommendations and improving systems.
The numbers are encouraging. The report says there has been around a 40% fall since the COVID pandemic in systemic deficiencies, identified through on-site inspections that require risk mitigation action.
And only 2 firms were referred to enforcement for potential sanctioning due to serious and systemic financial crime weaknesses.
That sounds good, but the report is careful not to present it as a softening of supervision.
Yes, it says that on-site work remains intensive, with supervisory teams at firms for at least a week, interviewing board members, senior managers, MLROs, and MLCOs, and reviewing up to 30 client files at a time.
That's important. If someone hears fewer enforcement referrals, they might think less supervision. But the point is, if supervision and remediation are working, fewer severe cases can be a sign of improved controls.
The MLRO and MLCO exit interviews are also interesting. The Commission interviewed 18 people who had resigned from those roles. In some cases, the interviews confirmed what the Commission already knew. In others, they produced useful new information, including information that led to on-site inspections.
That's quite a practical intelligence tool.
It is. It recognizes that people leaving key compliance roles may have insights into culture and controls that are not obvious from routine returns.
And culture is often where the real story sits. You can have policies, procedures and forms, but if the culture is weak, the system is weak.
For market access, that matters. Guernsey's position depends not only on having laws on the books, but on demonstrating that its regulator understands risk, supervises seriously, and acts where necessary.
This is also where simplification has to be handled carefully. You can simplify needless process, but you cannot simplify away the standards that give others confidence in you.
Yes, the international system can be irritating, but a finance centre that wants global access cannot behave as if international standards are optional scenery.
So, the practical question is whether Guernsey can implement those standards intelligently, with enough seriousness to be trusted, and enough judgment not to drown good business in forms.
That is the market access version of the whole report.
Let's talk about enforcement, the part of the report where the tone becomes quite firm.
The report says enforcement cases are few and that enforcement should not be the first solution to a problem. But it also says the regime cannot be toothless.
A good balance. A regulator that reaches for enforcement too quickly can create fear and defensive behaviour. But a regulator that never enforces loses credibility.
The Director General puts this in quite philosophical terms as well. Skepticism about over-regulation is not the same as hostility to enforcement. In fact, if you believe law should be sensible and proportionate, you may also believe it should be upheld where serious wrongdoing occurs.
That's the part that people sometimes miss. A lighter, clearer system depends on confidence that the rules which remain actually matter.
Exactly. The report's rule of law argument is that high-trust societies depend on people believing that law is real. If arbitrary power replaces law, or if wealthy actors can simply outlast enforcement, then ordinary confidence starts to erode.
And that's not just a constitutional point. It's economic. People take risks and make investments because they believe contracts, obligations, and standards will be upheld.
The providence matter is the major case discussed. The report refers to the collapse of the Providence Group of companies and a £38 million Ponzi scheme.
It's the sort of case where public confidence is directly at stake.
The report also discusses Court of Appeal judgments and the compatibility of the Commission's enforcement process with Article 6 of the European Convention on Human Rights.
That might sound legalistic, but it matters. Enforcement powers must be strong, but they must also be procedurally fair. Otherwise, they are vulnerable in court and weaker in practice.
The risk and financial stability section is one of the most interesting parts of the report.
Because it goes beyond internal supervision and looks at the wider world.
Yes. On risk-based supervision, the report says the Commission updated PRISM, its risk-based supervisory system, and created a new module for prudential and conduct supervisory visits.
The report also says that RMP action set fell from 404 in 2024 to 279 in 2025, while completions rose from 384 to 399.
That suggests firms were completing remedial actions and the number of new actions fell.
Again, not a reason for complacency, but an encouraging trend.
The report also says that the Commission received nearly 6,000 alerts and created 2,093 triages.
That's a lot of information. The challenge is turning data into judgment. Too little data and you're blind. Too much unmanaged data and you drown.
Which links back to technology. Better systems should help supervisors focus on the matters that deserve attention.
The financial stability discussion is more geopolitical. It talks about uncertainty around US policy, tariffs, conflict, inflation, AI, and competition between jurisdictions.
And it makes a key point. Guernsey is sheltered in some ways, but not insulated. Global shocks affect clients, firms, markets, costs, and competition.
The line I'd pull out is that financial stability relies on Guernsey's ability to continue to grow. That's not just an economic slogan. If the island does not grow, it becomes harder to support public services, maintain skills, and invest in infrastructure.
And AI appears in that section as an opportunity as well as a risk. The report refers to evidence that AI adoption can increase productivity. For a small jurisdiction with limited human capital, productivity matters.
That's a good way to describe AI. It's not just machines replacing people. It may be a way for a small place to stretch scarce expertise further.
Provided it is governed properly.
Of course.
And this is another place where the Director General's adaptation argument matters. If AI is changing the productivity frontier and other jurisdictions are changing their regulation, Guernsey has to ask what kind of institution it needs to be.
Not just what rules it had last year.
Exactly. The institutional question is, can the Commission keep learning fast enough while still being stable enough to inspire confidence?
That's a hard combination, actually. Fast learning and institutional steadiness don't always sit comfortably together.
No, but they are both necessary.
Let's try to pull this together. For me, the report is about the relationship between growth and trust.
For me, it's about reputation under conditions of change.
Those are closely linked. Growth without trust is short-lived, and trust without growth can become stagnation.
And technology accelerates both possibilities. It can make good firms more productive, compliance more precise, and regulatory work more intelligent. However, it can also create new forms of opacity, fraud, and operational dependency.
So the regulator cannot be nostalgic. It cannot say, "We understood the old world, and therefore the old rulebook will do." But it can't be dazzled either.
That is why the report's recurring word is judgment, even when it doesn't always use that word directly.
Judgment about which rules are necessary.
Judgment about when to simplify.
Judgment about when to enforce.
Judgment about where technology helps and where human accountability must remain central.
And judgment about Guernsey's place in a changing world. It's small, but not passive. It has to make choices.
The report presents 2025 as a year in which the Commission tried to use the end of a major international inspection cycle to turn toward reform. PIFs, digital finance, authorizations, equity release, bank resolution, data transformation.
And at the same time, it says that reform does not mean indulging the tiny minority who damage the system. That's where the enforcement and financial crime sections come in.
Yes, there is a moral logic to it. If most firms are trying to comply and build good business, the system owes them clarity and efficiency. It also owes them protection against those who pollute the reputation they depend on.
A strong point. A good reputation is a shared asset. It can be damaged by relatively few people, and the cost is borne much more widely.
Which is why the Made in Guernsey idea matters. It's shorthand for trust in the jurisdiction.
And trust is slow to build, quick to lose, and never entirely under your own control, because other people decide whether they trust you.
That's the international reality. Guernsey can make its own laws, but market access also depends on how others judge those laws and their enforcement.
So the report isn't a simple celebration. It's a progress report with a warning attached. The world is moving, and Guernsey has to move intelligently with it.
So that was our tour through the GFSC annual report for 2025. A report about applications and portals, funds, banks, insurance, financial crime and enforcement. But more deeply, a report about how a small jurisdiction tries to remain credible, competitive and practical in a changing world.
The challenge for 2026 is to keep that balance. Simplify where simplification is sensible, innovate where innovation is real, enforce where confidence requires it, and keep Guernsey trusted in the markets that matter.
For growth, the message is that prosperity is not helped by pretending risk doesn't exist. It's helped by a system that can tell the difference between good risk and bad risk.
And for reputation, the message is that Guernsey can embrace new tools and new markets, but only if international partners continue to believe it knows what it's doing.
That is the balancing act, and it is one worth getting right. Thanks for listening.
Goodbye. You've been listening to the Guernsey Financial Services Commission's 2025 AI-generated annual report summary. For the full report and more details on the Bailiwick's Digital Finance Initiative, visit gfsc.gg